Yeah.
Totally. Well, good morning, everybody. Keith Pitch
Good
here.
morning.
Yeah, good morning, Stacy
This
Chevalier.
is a really big day. Keith just announced pre-show.
What?
Big pre-show we do. That this is the last show in the treehouse.
Yup. We're moving
love the
out of
treehouse.
the house.
Are you going to keep your treehouse? Keith has an evening treehouse show on Thursday evening.
Yep.
So hopefully you won't tune into that. Are you going to keep the show going?
Yeah, Mortgage from a Treehouse will continue to go on. I'm probably gonna do the green screen thing, and I've got a couple pictures of it in here, so it looks like the set. But
the set.
Yeah, the set. Yeah. Well, you got to remember me in my financial wisdom and my 20 years of mortgage. I was actually a theater major when I got through college. So, I look at things like set and production and lights and camera and action, all that good stuff. Anyway,
yeah.
But yeah, so we're moving out of this place and we're off to Idaho.
That's so exciting! I can't wait. And when you do get settled and you're ready to show everyone your new home, Keith, it doesn't have a tree house. Maybe you'll build one, or you'll use your green screen set. But you know what it does have, everyone out there, Keith?
What?
The chicken coop.
The chicken coop?
I think we got to do something with the chicken coop.
It's funny you mentioned that, because the one tree I have in my backyard in the new place, the chicken coop is actually attached to it. So maybe I'll just retrofit the chicken coop and I'll have chickens walking around here while we have the show.
Yeah.
What do you think?
I love it.
I can hold my little chicken right here. Be like, oh, hey, everybody.
I know. I grew up with chickens. Fun fact about me, I love chickens, so I really hope Keith's family gets chickens.
This is a real estate and mortgage show, right?
Okay, yeah. Let's talk about rates. What are rates doing? We gotta talk about chickens. Maybe I should be a farmer.
Maybe, yeah. We are an all organic mortgage company, right?
Sure.
We do as much paperless as we can. But so what we always talk about every week, we'll start there, I guess. We'll add it to the stream and we'll talk about mortgage rates.
What are they doing? Mortgage rates dropped below 3%.
Whoop, whoop. We're back to it. For all of you that didn't get your refinance under 3%, it's back. Get it now.
For a short time, call Keith.
Yeah, we'll see how that works. I mean, it's there. I mean, there's still a lot of rockiness and uncertainty, and I think generally speaking, rates are going to be pretty stable through the rest of the year, in my opinion.
And when you say that, what do you think? Like just kind of staying where they're at, or kind of up, down, back and forth?
Well, yeah, they're always. I mean, let's look. This is the last year. This is the last year. They've been up and down, up and down, up and down, up and down. Right. So I think when we look at the range of 3.25 to 2.75, it's going to stay somewhere in that range for the remainder of this year, I think, because my opinion is the Federal Reserve is going to stay on the buying and purchasing of mortgage-backed securities. We're going to get healthy again in Q3, and then we're going to see financial momentum going through into Q4. And then 2022, I think we're going to get off to the races, and I do see substantial increasing rates. I would not be surprised by the end of 2022 that if we see rates getting back towards that 4%. So,
and we'll start our own roaring 20s in the 2020s.
Yeah. 2020 will be the roaring 20s. We'll replay it.
Yeah.
So here we go.
So what are we talking about today?
The mortgage industry has this weird affinity, and I'm trying to think of other, maybe like tech and computer engineering have a lot more abbreviations and acronyms for stuff. But in mortgage, we have a lot of acronyms and abbreviations. So we're going to talk about the ABC soup that we have here in mortgage terminology. And
it gets even more confusing because every company kind of does it different. So I think we're going to try to talk about the standard ones that should flow across all companies, and should help everyone out there understand, regardless of who you're talking to.
Yeah, and if you find a mortgage company that's not using these definitions for these abbreviations? I would be really curious to know that because I would like to know what kind of mortgages they're originating. Because to your point, Stacey, these are definitely very generic, across the board mortgage terms that, unfortunately, and I'm guilty of this as well. A lot of us mortgage professionals, we speak in our mortgagees, and we don't really talk to people about what. Let's give an example. What DTI means, right? Hey, your DTI is too high. Hey, your DTI is great, right? What the client's like, excuse me, what is DTI? Is that a good thing? Is that like a supercharged car or what? But the first one we'll kick it off is debt to income ratio, right? Debt to income ratio is one of those 4 key components to a mortgage. We have income, which is the derivative of your debt to income ratio, and then your credit, right? So those 2 things combined come together to give us a percentage ratio of your debts versus your income, hence debt to income ratio. And that allows us to
DTI. We call it DTI.
DTI. We call it DTI, and that's just the ratio we look to see if you can actually afford the mortgage or not. So based on all your credit and the proposed mortgage payment, is your debt to income ratio at or below an acceptable underwriting standard? So whenever you hear that mortgage loan officer go out there and say, hey, my main concern is your debt to income ratio, or they throw in there that DTI, you know what they're speaking about. They're talking about your income and your whole credit and debt capacity. So DTI is number 1. So do you know what PITIA? It's almost like a song, Stacey.
Principal, interest. Ooh, association dues. Look at you. Taxes,
insurance.
Yeah.
And association dues, right? It's
almost like
bingo,
PITI,
right?
and skip the A. So.
Yeah, right. Exactly. PITIA, PITIA, PITOA, TIA. And bingo was his name. Yeah, it works. So
wow. Okay.
We're gonna create a whole new song for this.
Yeah. And we're gonna steal Old MacDonald, but
well, no, bingo. Bingo was his name. PITIA was your payment of. Keegan, if you're watching this, let's do that next time we're in the green screen. We'll sing that song together. What do you think? So PITIA is really just the loan originator being lazy and not saying your payment, right? So it includes your principal on the first mortgage, the interest that you're paying on the first mortgage, your taxes, your insurance, and your association dues, if applicable, right? The association dues are going to be like your condos and some townhouses. And sometimes I almost said it. I almost said a PUD. But we're not going to cover the PUD today. That's
we are
development. We're not.
And even development. Okay.
But if you have an association due, we calculate that in. And why that's so important is when we look at, your debt to income, your DTI, we're looking at the PITIA, the principal, interest, taxes, and insurance, so we know that you can make that payment. So whenever you see that, either whether it's on a disclosure for an advertisement or your loan originator says PITIA, well, great. This is also referred to as a fully impounded payment. So it includes your mortgage payment, your taxes, insurance. And just so we are all clear, this came up this week with one of my clients who purchased a condo. The mortgage companies will not, I'll say that one more time, the mortgage companies will not collect the homeowners association dues. Mm-hmm. You, the homeowner, are responsible for paying the dues to the homeowners association directly. That's not going to go through any mortgage company or any mortgage servicer.
Yeah, really good point. Say that, yeah.
Put that out there. Super important.
Yeah. So when are we going to talk about a 1003 or not?
No.
Okay. So a 1003 is the application.
Yeah.
We call it the 1003. It's when someone's looking at their true application, will they see PITI somewhere, or do they have to add it all up?
Oh, no. Yeah. So that's a great question. So the principal, interest, taxes, and insurance and association dues, if applicable, will actually be on the uniform residential loan application, right? Okay. And so they will see that. And the other place that they're going to see that, which is a great segue, is the LE. right?
And
So
some
they're
people
going,
might remember a GFE, the good faith
oh,
estimate. If you
and the
bought a
L
home
and the
10 years,
TILA,
12 years ago, when did we go to switch? But anyways, you will still see GFE out there. It's non-existent. It is now,
2017.
okay, it's now on
Yeah,
loan estimate. So what do we need to look for, be aware with the loan estimate or the LE?
so the LE, and this happens all the time, folks. You'll get the call. Hey, we sent you the LE. Could you go in and sign it? Neat. I'm glad you sent me an LE. What is an LE? So a loan estimate is when you make an application with the mortgage lender. Hopefully in our case it's Loan Depot. So when you make that loan application, we by law within 3 days of that application, 3 business days of that application, we have to send you this specific disclosure, the loan estimate, along with the other specific disclosures that go along with the mortgage. But this one in particular, it's got a very specific timing requirement. So the loan estimate is going to give you a great 3-page overview of what's all in this mortgage, right? So instead of the good faith estimate that we used to have that said, hey, here's all the fees, here's your loan amount, here's your product type, and then it boiled it down to a funds to close number if it's a purchase, or maybe a cash out number if you're doing a refinance. Now it's all on the loan estimate. And the loan estimate starts out with what program you're on, is the rate locked, what your principal and interest paid portion will be.
Yep.
And then it breaks down your taxes, insurance, and association dues in a separate breakout all on page 1, right? That's page number 1. It's telling you what, when, and why, right? And then page 2 is all the associated fees: processing, appraisal, title, escrow, prepaid homeowners insurance, prepaid taxes. So it gives you all that great overview. And then the third page and the final page is who's all involved in your transaction. What title company, what real estate agents in a purchase, what mortgage company, right? So all that's on the third page. So the LE, aka the loan estimate, is your overview and roadmap of what you've applied for. So super, super awesome, very informative piece of documentation. Now, the LE, very similar to a caterpillar, cocoons up throughout the mortgage process and then turns. You like that one, Stacy, right?
That's awesome. I love the analogies. We also come up with a lot of analogies in mortgage. Okay, so yes, talk to me about this caterpillar.
So this caterpillar goes into his cocoon and then comes out after the mortgage process goes through and we get final underwriting. Comes out in the form as a butterfly, a closing disclosure butterfly, the CD. So the CD is very, very similar in format to the loan estimate. Instead of 3 pages, it's now 5 pages. And what there is a comparison page that says, hey, when you had your loan estimate, your last loan estimate said this much, and your closing disclosure says this much as far as funds to close. So what we're doing through the mortgage process is we're dialing in the exact closing date, the exact funds to close or cash out in a refinance situation. And you have to, here's where the CD or look, I do it just inherently, here's where the closing disclosure gets really, really important. The closing disclosure is, per the Dodd-Frank Act, you as the borrower, it's your last chance to change stuff without causing a delay, right? So you have to look at your closing disclosure and acknowledge it. Say, yep, this is what I want. I want that 30-year fixed at blah, blah, blah percent, blah, blah, blah APR and your percentage rate, and we're ready to go. And then you have to acknowledge it and you have to wait 3 days before you can go sign that loan document.
So some companies send out CDs really early to start that 3-day clock. We are one of those companies.
Us, yeah.
And it may not be exactly accurate, but it starts the clock. And then other companies wait until kind of the very end of the process, as late as they can, and then send it out. So it's just 2 different approaches. Both ways are fine.
Yep. So, but just know you cannot go in and sign your final mortgage documents, whether it's a purchase or refinance, whatever it is. You can't sign those mortgage documents until 3 days after you've received and acknowledged your closing disclosure. So super important there.
Yeah.
Those are the documents that we kind of get into. One other thing, going back into some more alphabet soup, so to speak, is the good old LTV. Loan.
It's not Louis Vuitton.
Oh, I never even thought of that. Isn't that just
That
LV?
That would be LV. Yeah.
Maybe
Just
it'd
kind
be
of
like
help with your Caterpillar analogy, taking
a,
LTV to the mall.
good try. Good try. I like it. There you go. There you go. Simple. So loan to value is a really quick mathematical equation of how much money you're putting into the transaction, or what the loan balance versus the estimated value of the house is, right? Quick and simple. The reason why it is important is there's minimum down payment requirements that you have to meet if you're doing a purchase. If you're doing a refinance, there's only so much leverage you can put on the house when you're pulling cash or pulling equity out of the house. There's only so much leverage you can put on the house, up to 80% of the house's value, loan to value. So that's the baselines, right? So that's looking at the first mortgage in relationship to the value of the house. Now, there's the next step in the LTV, and it's now the CLTV.
Mm.
So the C stands for combined. The LTV still stands for loan to value. So, want to take a wild guess at this one, Stacy?
This is when you take more than one loan, you combine them together, and you get a new loan to value.
New loan to value, yeah. So we do this. We're doing this a lot right now, guys. A lot of combined loan to values happening, specifically in that wedge between about $850 and $1 million purchase price. So with what we'll do, instead of structuring one loan that may have mortgage insurance, or once we get over this weird Fannie Mae loan limit of $776,250, we get into this jumbo market. So jumbo market
has specific to Washington County, the Tri-County market. That's not
the Tri-County market.
That's not a limit across the country, just so you know. But anyways, so for a local King County market, that's our limit. So when you go over that amount,
very good, because I'm multi-state licensed, so I should have known better than to say that. But when we go over the conforming loan limit, we can add a second mortgage to get us to a higher leverage amount, right? So if you want to put 5% down and you're in the jumbo space, you're going to have to do that in a 2 mortgage set. So you don't have mortgage insurance, number 1, and number 2, that you can still leverage up to 95%.
So the first mortgage would be 80%. Second mortgage, if available, you could go up to 15%. Combine them together, with 5% down, you have 95%. You're paying off 2 separate loans. Other things people are doing right now is because people's equity in their houses went up, they're taking, if they had to, and combining it back to 1. That's possible too.
Absolutely. And that is a huge shout out that I'd love to say right now. If you do have 2 loans, let's talk about that second loan really quick. That gives us that combined loan to value between all liens on the house. Just a really quick reminder. Typically, your second mortgages are home equity lines of credit. They're HELOCs. And I forgot to make that banner. So home equity lines.
I'll put it in the chat.
Yeah, HELOC. Those home equity lines of credit, guys, they're adjustable rate mortgages, right? They're going to move. And that's what ARM stands for. ARMs are adjustable rate mortgages. So HELOCs in that case there's 0 time frame that they're locked in, right? A typical first mortgage, adjustable rate mortgage, would be locked in for 5, 7, or 10 years, right? You don't have to worry about any rate movement, any rate volatility for that set amount of time. A home equity line of credit has zero fixed time, right? Every month that the prime goes up or the prime rate goes down, that mortgage is going to adjust accordingly. So I just want to say this, with rates dipping back down below 3%, and if you're in the position that you have a HELOC, you should definitely have the conversation of combining that first and second mortgage and just making 1 loan. Because when rates start going back up, which I believe that's 2022, those HELOCs are going to get expensive fast because they can adjust every month, and you can see it get out of hand relatively quickly. So lock in the rate now on a fully amortized payment, right? So
yeah, and check with whoever you work with, or check with someone like Keith, and because there is a possibility that the HELOC is not a line of credit. It would be called something different, but it is possible it's a loan that doesn't adjust like that. That is more rare. That's possible. So talk to someone about it. Yeah.
Yep. Yeah. One great thing to do is check out your mortgage statement that you get from your second loan provider or second lien provider, I should say. It'll tell you what it is. It'll tell you if it's a home equity loan is what you're looking for. If it's a loan that has an installment payment, just like a car, a mortgage, what have you, or if it says home equity LOC, sometimes they put it like that. That stands for line of credit. So super important to know that. Stacy, I'm gonna set you up for one. So if your LTV is over 80%, what 3-letter abbreviation are we going to tack onto your payment?
PMI.
PMI. Dun, dun, dun.
Private mortgage insurance.
Private mortgage insurance. So general rule of thumb, when you're doing one loan and you're over 80% loan to value, you're not putting down a full 20%, you're going to be subject 90% of the time to private mortgage insurance. Who does private mortgage insurance protect, Stacy?
It protects the lender, not the consumer.
Yes.
What? I just did a whole video on this. I don't know if it's even released yet, but yeah. I don't know. Go to our YouTube page. There's lots of education there, but yeah, PMI protects the lender. Most people do not know that.
Yeah, we get calls about this all the time. They're like, well, I see PMI on there, so do I really need homeowners insurance? Yes, you do. So what
does PMI do?
So great question. Private mortgage insurance pays the lender should the loan default, right? So if you go out and buy a house and you put down 10%, let's say, then all of a sudden you come into a hardship and you can't make the mortgage payment and the house goes into foreclosure and the bank takes the property back. The private mortgage insurance policy will pay that lender the loss, right? The coverage in the policy. So what this has actually done, this is a great thing, folks. Everybody thinks, oh, private mortgage insurance is horrible. It's really expensive. It's the worst thing since sliced bread. That doesn't make sense. But they think it's a bad thing. And let me tell you, private mortgage insurance is your friend, because especially in such an appreciating market that we're experiencing right now, we can't save fast enough for a 20% down payment. So it allows you as a potential home buyer that doesn't have a full 20% to get in, because that was old school thinking. That was very popular in the 70s, well, up to like the mid 80s when we really started doing higher leveraging. But private mortgage insurance gives the banks the peace of mind and the ability to lend to you when you don't have 20% down, right? It would absolutely squelch the market if we didn't have less than 20% down options. The market would not be where it is today. And let me just give you a quick example of private mortgage insurance. I was working with a client right now who wanted to buy an $800,000 house. They had really great credit, over a 740 credit score, and they were buying a detached house, single family, standalone house. And well, we really want to wait until we have that other 10%. And I said, you realize your private mortgage insurance is going to be roughly about $90 a month. And they said, what? It's only $90 a month? I'm like, yeah. How long would it take you to save up that other $80,000 to put down full 20%? It's like, oh, it's going to take me at least another year, maybe a year and a half. You needed 2 bonus cycles to get there. And I said, okay, if we take the same $800,000 house and we assume just a very moderate 5% appreciation, you're going to lose out on $40,000 of appreciation in 1 year. So if it's taking you a year and a half, that's $60,000 worth of appreciation, not to mention principal pay down, that you're going to lose because we didn't spend $100 a month, right? So $90 a month. So it's really interesting that mortgage insurance is in our in our market, and it's really awesome because it's the best tool that you can have as far as the cost of getting into a house.
Yeah, we could do a whole show about MI. There's a lot to it. It impacts different programs differently, FHA, conforming, jumbo. So yeah, please just reach out. Someone will help educate you. One thing, my last note on PMI that most people don't know, even loan officers, the more, if you're over 80%, but say you're putting 15% down, your MI is a certain amount. Now say you decide we're going to put 17% down. Your interest rate could actually go up because you're getting less MI. You're putting more down, but you still need MI, but it's less MI, so the bank is less protected, and so you could take a higher rate. So no one understands that the more you put down could increase your interest rate. So look at all those details with Keith Pitch.
Yep. You know what I'm doing right now, Stacy?
What? I don't know.
I'm gonna put my hold on, I'm gonna pause that. I'm gonna put my Mortgage from a Treehouse link in here about mortgage insurance because I've got a 41-minute video. If you really want to dive deep into it, folks, this is where you got to go.
Yeah, go there. You can also go to our YouTube page. I don't know what it's under. I think it's under Loan Depot Puget Sound, but there's more MI videos there as well.
Oh, yeah. So super awesome. Okay, so we got time for one more.
Okay. Make it a good one.
Let's
because there's thousands. What are we talking about? Like 6
of them? Yeah, there are thousands. Okay, I lied. We covered them all. We covered the ones we wanted to.
How about one more to talk about would be an ADU.
Oh, ADUs.
It's just big in our market. I think it's big in most markets. So ADU is accessory dwelling unit.
Yes. An ADU.
There's other names for it around the country, but generally right in the Seattle market, we generally stay with ADU.
Yeah, ADUs. And so the accessory dwelling unit is getting very big. And there's one actual metamorphosis to the ADU is a DADU.
What is that?
A DADU is a detached ADU.
Oh.
So ADUs were all the rage, especially with all of the construction that we have here with the split levels. So they would add an extra unit in the basement, right? The basement level. And they would partition the 2 floors off and have living space upstairs and living space downstairs and take a single family residence and create 2 units out of it. Oh, I need a key over here. And create 2 units out of it. So that's called an attached ADU, right? So there's an additional dwelling unit.
Sometimes they're above garages. Sometimes they're part of the house. Sometimes
exactly.
They're in the backyard, and then you'd have detached.
So now Seattle specifically changed their zoning. They're upzoning right now. And what that's doing is it's allowing people to add density to single family lots. So they're allowing a lot of folks, this is very popular in like West Seattle and up on Beacon Hill, that had those alley row garages. They're flipping those garages or adding an alleyway detached accessory dwelling unit. You know, these are 400 to 900 square feet ADUs that are now detached from the main structure. So super acceptable, super awesome way to generate additional revenue and rent it out. Or if you're in a multi-generational household and you need some more space for grandma and grandpa and you want them there, you can definitely do a ADU, right?
Yeah, but before you start building, talk to again. I'm going to keep saying talk to a professional that knows, because there are rules and policies about when you can finance them. If you have a duplex, can you have an ADU? If you have a fourplex, can you have 2 ADUs? All of that stuff you need to understand before you just start building.
Yeah, absolutely. You need to not only understand the building side of it, you also need to understand the lending side of it. Because there's some very specific rules when it comes to ADUs or detached ADUs based on the subject property zoning, right?
Yeah.
Case in point, we have a lot of people coming to us right now saying, hey, you know, I live in this house and I have a detached ADU that I'm renting out for $1,500 or $2,000 a month, and I want to use that income on that detached ADU to qualify, and your house is own single family residence and you live there. We can't use that rent, right? So definitely understand the lending side of it and understand the building side of that. And we'd be happy to point you in the right direction for builders that are building ADUs and detached ADUs all over the city, as well as we'd love to talk to you guys about the lending side of it, because success starts with the finances, guys. I say this over and over again. If you get your money right, the whole puzzle comes together. If the money's not right, the puzzle is not going to come together in the way that you want it. So get the money right first, then everything else follows. Makes it quick and simple.
Nice. Love it. Good tagline. Well, this was fun. I mean, we could do this for hours. I'm not kidding you guys. We have a SharePoint site, our local team does, and we actually have a button on our SharePoint site that I think it's called ABC, and it's just filled with acronyms.
Yeah, ABC abbreviations. It's pages and pages and pages long. So we'll definitely do some more alphabet soup, because it's stuff that you see out there in advertising, stuff that you talk to people about as far as mortgage lenders are concerned. I try to, as I showed in this video today, or this live today, that as much as I try to not use the acronyms, by default I end up using the acronyms. And I'm like, oh man, don't do that. So right on. Well, join us next week. Everybody have a great Memorial Day weekend. Any plans, Stacy?
I am going to go see some good friends in Suncadia. So we are excited and ready to get out of town for a few days. What about you?
There you go. I'm moving. I'm moving this week. So
yes, that's fun too. A lot of work, but exciting.
Yeah. So, we'll catch you guys next Thursday, same time, same place, 10 a.m. Thursday mornings for Real Estate Now, and have a